further up on.
So we're going to get started tonight. Got a couple new people introduced real quick before we give it to our guest speaker. We got Mr. Victor Nice and his wife Millie. They just moved here from Serbia.
Yeah.
And Victor actually just completed his course with Nice as well. And took the test. He's got to redo the state. You are where?
Tomorrow, I take it.
Okay, for the first time?
Yes.
So,
I'm taking it the first time.
so you guys can get together.
Okay.
No, you're taking it first time, right?
Yeah, this is my first time.
Awesome. So after class, we can quiz each other.
Ready or not.
All right, so we got Mr. Michael Rudolph here from Community First tonight. He's got a little presentation for us and go through the loan products, talk about what you can expect, and you guys can get to know him as well. So if you need something, call him right up. All right, Mr. Mike.
All right. Does everyone have a presentation? I think maybe you need some. Yeah.
Quick for us. Okay.
There you go. Okay. I'll sit because, to be honest, these tend to go longer than usual because people ask questions, which is fine. And if anyone wants to ask a question, throughout the presentation, just go ahead and interrupt me and we'll go over it. But my name is Michael Rudolph. I'm the Mortgage Division Sales Manager at Community First. This is my second time living on Guam. When I lived here the first time, I was in property management and left, went to Hawaii, and I did motion practice, legal research, and writing for a community association law firm. So all we did was represent community associations, and I was in the litigation section. So I dealt mainly with construction defects, and then some very nitpicky owners that were suing someone over a mini bougainvillea and not a regular bougainvillea because it violated the covenants of the association. And then I went to the other side of real estate during the mortgage crisis in Florida. So I was in Winter Park, Florida, which is a stone's throw from Orlando. And you guys didn't see foreclosures here like you saw on the mainland. You saw them in San Diego, I bet you. So I did foreclosure defense. So we were there to delay. We were picking holes in all of the bank's documents, just trying to delay. I mean, they didn't pay. So they were going to lose no matter what. We were just going to make sure that they lose very slowly so that we could negotiate a short sale so that the bank would accept less than the lien amount and convey the property. Or we would negotiate loan modifications, and then when the banks were unreasonable and they weren't willing to take a haircut, we just filed bankruptcy, and then the banks got nothing. So when I came here, I'm going to the more conventional retail side of lending. So I kind of have a perspective on both sides. And I kind of take that with me. I don't want to see people get into a home that they can't afford. There are limits on what you can afford, but you can tell by someone's finances, looking at their credit report, you can tell if it's going to be too much of a house for them, and I don't want to put them in that situation. And if there's a product that is better that someone else has, it's too small of an island for me to just close that deal, for me to make that closing. Certain loans are better at other institutions than ours. And I'll get into that as we go through. But if you want to go to the next slide. So this is going to be the overview of the presentation, our workflow, which I think is important for realtors to understand. Every institution is slightly different on how they process loans. So if you understand how we do it, then you understand where we are at each stage of the process, which really helps in communication. This has been a big thing, pre-qualification versus pre-approved. First-time considerations, they're really no-brainers, but you have to remind your customers. I'll go over a matrix of loan programs that we have, and at that point, if you want to zero in and have specific questions, there are some nuanced differences. Supporting documents also, very simple, but I put it up there. I included USDA loan timeline. We're one of the few lenders that do it, but in this environment, I'll tell you, it's just not worth it. There are other things that are good to know, and then our other products that the credit union offers. So if we can go to slide 3. So this is our workflow. We meet with borrowers first, and we do a pre-qualification. So what we do on our pre-qualifications does not include a credit check. We only pull credit if you submit an actual application. So we sit there and we vet the borrowers. We ask them probing questions about their employment, gaps in employment, their liabilities, and that sort of thing. And after a while, you're interviewing someone. It's almost like an interrogation. You know if someone's not being truthful, or they're kind of withholding something, or if they're just making it look like life's full, like a bowl of cherries. Condo questionnaires are critical because not every condo is eligible for financing, and not every condo is eligible for a fixed rate mortgage. Condos in general, they're somewhat risky because what affects one unit affects them all. So if a condo does not have full typhoon coverage built into the HOA fee, meaning you don't have to get it on your own, then it's not going to be eligible for a fixed rate. And that's because Freddie Mac will not allow it. It's their loan program. We can do it on the portfolio side, but you have to get your own separate policy. The other thing that kicks condos out of the fixed rate financing with us is if the developer still has a majority control in the HOA board. So like Talo Verde, there's a lot of vacant units, the developer still owns it. Because the management of the association hasn't passed down to the unit owners in its entirety, then Freddie Mac will not allow us to do a fixed rate there. So we offer portfolio. And I'll get into that, I'll put it at the end. There's another lender that will actually do that fixed. Application and supporting documents. We take it in, we're gonna process the loan. Within 3 days, you're gonna get the initial loan estimate. All it is a breakdown of your loan, all the fees and costs associated with it. And at that point, we pull credit. If there's issues with the credit, that's when I let the borrower know. If there's things that need to be clarified, that's when I bring it up. Underwriting the loan automatically goes to underwriting. So first it goes through certifying the income through the tax documents and the paychecks and bank statements. Sometimes we will just do it solely based upon stated information on the application and a credit check. So whatever you're telling us on the application, we're assuming it's true at this time. And we will give you a conditional approval. All approvals are conditional. But when it's on stated information, it's really conditional. Because you're gonna have to prove to us your income through tax returns, bank statements. We're gonna scrutinize any large deposits to make sure that one, it's not loan proceeds that didn't show up on your credit check, and that it's not a private note for a friend or family member trying to help out with the transaction.
What do you guys define as large?
50% or more of their gross monthly income. So we're just expecting their monthly income. Anything over that, we have to question it. We do not order the appraisal report in practice until the loan's been approved. Because we don't want the people to waste their money, $750, because it's not like $300 in the mainland for an appraisal. It's $750 for a basic one here. We don't want them to waste that money if they're not going to get approved. Because once we order it, it's done. Once the appraiser gets in his car and leaves, he's going to bill you for it. We can, however, order the appraisal report upon the borrower's signature of the loan estimate. We can do it then, and I leave it up to the borrower. If you're in time constraints, I'll let you know that you can do it this way, but just know that it'll be a sunk cost if you get denied. The appraisal review, also with the appraisals, that's when you have to establish a membership with us. There's no application fee, but in order for us to do a loan, you have to be a member of the credit union. Membership's really easy: live, work, or worship on Guam. There are some caveats. I have met people at the airport at baggage claim and had them sign their signature card. because they're here and they use their realtor's address, but it was really for an investment loan, so they weren't going to live there anyway. So we can make accommodations. There are also accommodations to service members. If they're not actually physically present, there's some workarounds. When the appraisal comes in, we review it. Rarely ever do we question the value. What we're looking for is, does the report conform with the requirements to sell the loan to Freddie Mac in the aftermarket, in the secondary market? We will ask them to make changes to make sure that the legal descriptions match across the PTR, the appraisal, and your contract. So for those of you who've been here long enough, and you haven't been here that long, but there are very few housing developments where you can compare house A on street 1 against house C on street 10 because it's the same floor plan where you can get comps. Everything here is it's all self-built. Only in condos is it common that you can compare units within the same building. So the adjustments to the value, if those adjustments are greater than 20%, it has to go to management for review. Fortunately, everything with Community First when it comes down to mortgages is all done out of the Tamuning branch. Applications are received there, applications are approved there, loans are closed there, your payments are processed there, and every management level executive that has lending authority is there. With the exception of our CEO who's in headquarters, but.
You said which branch? Which branch?
Tamuning.
Oh, okay.
Yeah, but our CEO, he's in the game.
Are you guys only based on law?
Only on loan. Yeah, so our call center is actually in Tamuning. There's no off-island anything with us. So if you have a problem, it gets resolved pretty much in Tamuning. Once the appraisal review is done, we'll do a closing workup, make sure all the conditions of the commitment letter are met. If anything is missing, we let the borrower know. For the most part, if there's a couple items that the borrower needs to bring in, I don't mind accepting it at the closing table, but that's kind of a judgment call because you get to know your borrower, you get to know your clients. Some clients, Matt, you've done this, 8 years? You have to drag them by the ear to do anything. Some clients, they come fully prepared and they're anticipating everything. So homeowners insurance policy, your last pay stub, sometimes I don't mind getting that at the closing table. Certain borrowers, I will make sure that they give me every single thing before I even have them come into the branch or even give them a closing date. But we all recognize that we have contracts, deadlines, and it's not fun to constantly get it and ask for an extension. There's the final loan estimate. That's when we don't necessarily lock the rate, but based upon the TRID rules, once you do a final loan estimate, those fees and that rate is you got to stick to it for about 2 weeks. And the next day we do the closing disclosure. All of our estimates are conservative. The title company issues the final closing disclosure. We do not apply any discounts that the title company offers because it's up to them whether or not they're going to rescind that. So if you buy the owner's policy and the lender's policy at the same time, you typically get a 30% discount. We won't apply that. That's their discount. If you guys have a relationship with an escrow officer and you're able to massage a fee here or there, then that'll show up on the final closing disclosure. So if the borrower bases their cash to close requirement based upon our closing disclosure, they're safe. If anything, it'll be less. Okay. Go to the next slide. So pre-qualification versus pre-approval. This seems to be really important to a lot of realtors, considering it's a seller's market and sellers are getting multiple offers on one home. With us, there really isn't much of a difference between a pre-qualification and a pre-approval. Even the pre-approval is conditional. When you've done loans, when you start looking at bank statements and you start questioning things, you can kick someone out of the loan program right then and there because they weren't exactly truthful or something's there that they can't explain. So it really is all conditional until they've satisfied every condition on that commitment letter. Because what happens is we upload the application the day before the loan closes to Freddie Mac, and we get a feedback report, and that's the final. Then everything's locked, everything's squared away, all conditions are satisfied. Up until that point, the loan is still conditional. But a pre-qualification from us prior to application means we haven't had the luxury of a credit report. After application, we can give a letter or a summary, and at least we'll know if the credit score is eligible, and we'll also be able to confirm what the fee pricing is based upon someone's credit score. But really, it's all conditional. And I think if you want to come and visit, bring in a borrower, sit with us so you understand how we go through borrowers and vet them, and then you'll be more comfortable with our process and the validity of a pre-qualification that one of my loan officers issued. I'm trying to think what else is there.
How long it usually takes?
This, if a borrower shows up with their tax returns and their pay stubs, and they make a list of all of their loans and credit cards with their current balance and their minimum required monthly payment, 20 minutes. Yeah. Self-employed borrowers are difficult. You realtors are difficult when we try to evaluate you, because we need to see the Schedule C. Because you've got your gross profits on the Schedule C, and you've got your expenses. And the net profit is what, a self-employed borrower is evaluated off of, not the sales. And this is another thing just to keep in your mind. The more you pay in taxes, typically will translate into the ability to get a larger loan amount. So the expenses that are put on your Schedule C, you don't have to claim every single thing as an expense. You don't have to write off every meal. You don't have to write off your desk fee. But it does lower your tax liability. So there is a give and take to claiming everything, so you pay less in taxes.
Nikki, what's a desk fee?
Here?
Yeah.
Hey, good for you, Matt.
Zero. Got it.
So, so it's 20 minutes, but if they have questions about loan programs, we'll sit all day long. 5% down, 3% down, whatever they want to do. Okay. Next slide, please. First time considerations, these are just easy. Do, save, pay everything on time, stay employed, don't change jobs. Not telling you not to take a promotion, but just know that when you get a new job, there's typically a 90-day probationary period for a new hire. And we can't close the loan within that time frame. So it could extend the contract, or the seller just said, hey, no thanks, I'm not waiting 120 days. They should all pull their credit report and know what's there. Here on Guam, what I've noticed as the biggest culprit on damage to your credit report is diagnostic laboratory services. You go and you get your blood work done, you never get a phone call or anything from diagnostic laboratory services until they send you a bill. Because they made one request to the insurance company, they didn't get paid in 15 days, so then they put it into collection. So it shows up on your credit report. That and ambulance services. It works the same way. They don't get paid within 15 days from the insurance company, it goes straight to collections. It's really frustrating. Do not buy a car. Please. Nothing has crashed a mortgage application more than a Toyota Tacoma. That is an $800 car payment, and everybody drives them. If you go out here and stand there for 5 minutes, you're going to count 30 Tacomas easy. And then don't miss payments. Don't get a new credit card, and don't increase your credit limit. Something else to consider, if you've got people that you feel it's going to be a long-term working relationship, trying to find a home, ask them if they've co-signed loans with anyone. We can exclude that co-signed loan if they're not paying for it, provided we can document it. So As far as I know, we're the only branch or institution that when you make a cash receipt at the counter, your name is printed on the receipt. You go anywhere else, it's just a regular thermal paper receipt, it has no name. So if you've got your nephew or a girlfriend or someone making cash payments at the counter, there's no way to really prove that the girlfriend was paying the loan and not the prospective borrower. The best way, tell them to go ahead and get a payroll deducted, or open up an account where the loan is at, deposit money cash, go online and transfer it that way, and pay it that way. Because then you can print out a 12-month history to show that for the past 12 months, the girlfriend's been paying the loan and not the borrower. Then we can exclude that liability. Okay? Even husband and wives, open up a separate account, only under your name, the person who's actually paying the loan, because then it's considered commingled funds, and then we wouldn't be able to exclude it from the borrowing spouse. Okay. Next slide. Okay, loan products. We've got a bunch. We offer Freddie Mac. We sell all of our loans to Freddie Mac. If any of you have not seen the movie The Big Short, please go see it. Raise your hand, who's seen it? Okay. The way it works, upstream, you close your loan with me, in 30 days we're going to sell that loan to Freddie Mac. Freddie Mac takes loans from all over the country, like Fannie Mae and Sallie Mae and Ginnie Mae, and they put them in risk levels based upon your credit score, the loan product, and what they do is they pool them together and they form an investment product. And it gets thrown over to the guys in Wall Street. So if any of you have retirement accounts and anything's in mortgage-backed securities, you getting a mortgage is contributing to that. So that's the upstream effect. So when we close loans, because we're selling them to Freddie, it's with the upstream effect in mind. There has to be uniformity to the underwriting process and the criteria. We only do what Freddie requires. We don't do anything more. Some lenders will take whatever your credit limit is and make that your monthly payment. And that gets factored into your debt to income ratio. We use what's on the credit report as what the credit report shows as the monthly payment. So if you've got a Macy's card, that's typically like $27 a month for the entry level card. We'll just use the $27, but Bank of Guam, they use a percentage. So your percentage is going to be based, your monthly payment is going to be based upon your limit. That's going above what Freddie Mac requires. We don't do that. Even the VA, the VA loans are guaranteed by the VA. Freddie Mac buys them. So what happens is I give a loan to Mac, Freddie Mac buys it back for me, and I can give him a loan. And it's repeat over and over and over again. Portfolio loans, that's our money. We do not sell that loan. So that's once that money is out, the way we get repaid is through the monthly payments, the loan servicing. Okay? So with Freddie Mac, we can go up to 95% financing under your standard Freddie Mac loan product. So that can be with mortgage insurance, or you can get a first mortgage at 80% and a second mortgage at 15%. And then you come up with a 5% down payment and no mortgage insurance. To be honest, that's the better way. If you can avoid mortgage insurance, you should. Home Possible and Home One, they're very similar, except Home Possible has an income limitation. So if you make too much, then you would only be eligible for Home One. And both those loans are only for people if they're first time buying a house, or if they haven't owned a home in 3 years. And on those, we can go up to 97% financing. It's a 3% down payment plus mortgage insurance. The VA.
Can you just piggyback on that one too?
A second? We right now we're not going over 100 LTV. Yeah. For a while we were going at 103, 102 and a half on the Home Possible. But about a year and a half ago, they kind of tweaked the loan program and they introduced home loan, and we just stopped. Yeah. And I went through the mortgage crisis, and Guam never really had to worry about it, but those loans were super risky because you're not going to have any equity in that house for a good 10 years. So if someone sells a home a year after they buy a VA or a year after they do a home possible, they're going to pay money to get out of that house. They're not going to be able to afford to clear your fees as realtors, the commissions, if it sells, unless they made upgrades to the property. VA, we do VA. Our rates are competitive. Right now, they're tracking with Freddie Mac. So a par rate right now is 3%. Par means just the interest, no fees from us, no origination fee. So right now, VA is tracking. Bank of Hawaii, their rates are better. Pentagon, their rates are better. They get to make it up in volume, especially PenFed. But if you've ever had to deal with PenFed or Bank of Hawaii on a loan, everything is done in Honolulu. The loan officers here, they don't approve anything. The underwriter, Bank of Hawaii doesn't approve anything. It's all done in Hawaii. And if you have a problem, you gotta wait until Hawaii time to give them a call. And PenFed, if you look them up in the phone book, it rings in Seattle. So I don't understand that. But where you're getting with us is, I think customer service, the rate really isn't that big of a difference to me, going from 2.875 to 3%, to be able to walk into a branch and be able to have my problem resolved. Okay. Plus, since it's all done off island, it tends to take a little bit longer.
Do you guys actually underwrite 15-year VA loans on island?
Occasionally, but most people don't do it.
I didn't know we did that.
Yeah. The VA also allows, I believe, for a triplex, so long as you're going to occupy one of the units. But our contract with Freddie only permits us to do a duplex. So every lender has their own contract. So Bank of Hawaii has Fannie Mae, and they have a contract. Bank of Guam is Freddie, Coast is Freddie. How the terms of their relationship is unique.
And that's important to know too, because you got to know where to send your buyers, right? So if he comes and says, I want to fight with everyone on the island to find a fourplex in my VA loan, I can't even help him. So if you send them to him, it's going to make us look like we don't know what we're talking about, right? So that's why it's important to understand and have a relationship with their lenders. PenFed only does single family, so they can't even do a duplex. They do duplexes, and there's a couple that do up to 3 or 4 as well. So you gotta know your lenders, know your products, and know where to source them, so that you're the expert for your buyer.
Yeah, and if we can't offer it, and I know who does, I'll put you in touch with a loan officer, so you can keep that image to your client. And I get referrals from other loan officers. The good loan officers at other institutions, they understand that you shouldn't be here for the quick kill. It's a small island. It doesn't take long to run into somebody.
First Hawaiian does up to 4, and then if anyone who's working with Bank of Hawaii, refer them to a different office.
Something about PenFed, we had a member. He's got all of his company accounts. He's got 3 commercial loans. He financed the construction of his home in Pago Bay, and he wanted to buy a townhouse at Telo Verde. I told him to go to PenFed because they'll do a fixed rate, and we'll do an adjustable. We have no problem giving him a loan, but he's going to want a fixed rate, and I knew that because I knew him. PenFed, they don't sell their loans. They don't sell them to the secondary market. They don't sell them to Freddie. They portfolio everything. So they can dictate all the terms of their mortgage. So, but their product category is slim. 20% down or nothing. They keep it simple. USDA, it's a great loan program if you can marry the right buyer and seller. But there are very few sellers that will accept a contract under USDA. And if you've got a borrower that is dead set on USDA, Their next best option is VA if they're qualified, or a Freddie Mac with 3% down. It takes 120 days to close a USDA loan. So a seller is not going to take $300,000 from the USDA if he can get $300,000 on a VA or a Freddie Mac loan, because it will take 60 days or less. Portfolio loans, we can go up to 90% LTV with a first and second. We cannot do mortgage insurance on our adjustable rate mortgages because the mortgage insurance company that writes policies on Guam will not insure adjustable rate products. So that's why. So it's really not bad. Like Sauk and Camilla, those new condos behind the Mini Lao Church, it's basically Tossie 17 2.0. They're really nice, they're a great value, they're really big, but portfolio only. But we actually, I closed 3 loans on that property within 2 weeks, and we can't do any more loans in Sauk and Camilla. So that's another thing to consider. Some lenders will say no to a condo development because of risk concentration. We were only willing to have 10% of the units leaned up by Community First. We don't want to have all the eggs in one basket. Because if there's a super typhoon or somebody's playing funny business with the HOA and that property degrades, then we don't want to have too much investment in that property. Occasionally, we might make an exception if, for example, someone's putting like 50% down or something like that, where the risk is low. Now, something that's different for us, and I think we have the best land loan program. We will refinance, purchase land, 80% financing, 20% down payment, 15-year term, fixed rate, and there is zero expectation or requirement to develop it. If you want to buy it to grow grass, that's fine. Bank Pacific and Coast, they tie in the acquisition with the development. And then our Freddie Mac investment loan.
Do they do 75 as well? Or do they do 75?
Bank Pacific does 70 under a 20-year term. But the interest rate, I think it's a little bit lower than ours, but they tie in that requirement. And we can do, and all investment products are 15 years on the residential side. We don't have a license or a contract with Freddie to be able to do a 30-year term of an investment product. Something that's not in here with the land is, the prices have gotten out of hand for just an average home in okay shape. So we're seeing a huge increase in construction loans. So if people are having a hard time finding a house, to be honest, they will be able to build a bigger home if they build it instead of buy it, just because of the cost. So what can get you a $300,000 construction loan? You're going to wind up having a home that's worth $380,000, $400,000. So it's cheaper to pay for a $300,000 mortgage for a home that's worth $400,000 than it is to go out and buy a $400,000 house. Next slide, please. So supporting documents, this is basic. Pay stubs. If you're a business owner, we need the GRTs for the year. Gift letter, if someone's getting gifted funds are okay so long as it's from a family member. And we need a gift letter. We may need a proof of pay downs or a statement of account to exclude certain debts. So if you have a car loan and there's 10 payments or less left, we don't have to count that debt against you. So we may not ask you to pay it off, just pay it down. Next slide. This is the general timeline for USDA and the turnaround speed for each phase. It requires an appraisal, and in order for the credit unions to certify the habitability of the home, we get an engineer's report. I have never seen a USDA home loan pass the first engineer's inspection. It always requires a re-inspection. GFCI outlets have to be where they're supposed to be. They measure the thickness of the roof coating. Air conditioners that are inoperable either need to be repaired or removed. They even look for the steel belt on the hot water heater to secure it to the house. Little things. And then they have to go back out and re-inspect. Then we get all of the documents as if we're ready to close tomorrow. And then we upload it to USDA. And USDA takes at least 7 days to review that packet and give us back the final blessing. And then we do a closing disclosure and have the loan closing. So if you can find the right buyer or seller, by all means. But under normal circumstances, you're probably not going to have to deal with this too much right now. Next slide. So this is good for realtors to know. Even on the portfolio side, we follow the available credits, and it's based upon the loan to value. So if you're putting 10% or less down, you can get a 3% seller credit, or a 6% or a 9%. Investment properties, it's capped at 2%. Now, kind of what gets into this, or is all that affects the seller credits, are sales concessions. So if you want to go to the next slide, I think that's the sales concessions. So personal property is a sales concession. Anything that is not a fixture is a sales concession. The air conditioner is a fixture. The microwave plugs in, it is not a fixture. It's considered personal property. The furniture, if there's a container on the property. So what happens is anything that's personal property, we would require an addendum where the buyer and seller agree to a garage sale value for those items. And so long as the cumulative value doesn't exceed the allowable seller credit percentage, it doesn't affect anything. The reason why this is in the Freddie Mac's underwriting guide, and we only do what Freddie asks. You probably haven't had to deal with this, Matt, maybe with Bank of Hawaii or Coast. They're a lot bigger than us. So when they get audited, and if they are forced to buy back a loan from Freddie, it doesn't really hurt their bottom line as much. We're a smaller credit union. So if we have to buy back a loan because we didn't follow the underwriting regulations, it hurts our bottom line more. And we can only handle so many demerits by Freddie before they pull our contract. So that's the reason why we ask for it. We only do what's required.
Does the statement like conveys a no value?
You gotta give me something. Like a microwave, $5. I mean, how much would you buy a used microwave for at a garage sale? $5? Yeah. Right, if it works. Yeah. So, yeah. The appraiser's not gonna give value. Nobody scrutinizes it. It's just a box that we gotta check to avoid an audit. Okay, next. Sales of tenant occupied properties. I am going through one right now. We're getting ready to close, and then when the appraiser was about to come in and he went back out to re-inspect, he goes, oh, there's a tenant. In order to close the loan, there needs to be a notice to vacate. Whether or not that notice to vacate has any bearing on the lease agreement, we don't care. We just need it in the file, because when we close the loan and we're selling it to Freddie Mac, paragraph 6 says the borrower is going to occupy the property within 60 days. We sell the loan to Freddie after 30 days. So we need something in the file to show that they are actually going to be able to occupy the property. And that's how we ensure that on a tenant occupied property, they're going to be able to meet that requirement of the mortgage. Okay, otherwise we're selling a loan to Freddie that we shouldn't be. And then it's considered an investment product. Now, this particular scenario, they were pulling the COVID rent relief, as far as I'm concerned, nonsense. They weren't paying, you gotta evict them. And we have to wait for an eviction order. And we need to get verification from the marshals that they've actually been taken out of the house. I don't know if any of you have gone through it as a tenant or witnessed it, In Florida, I did a lot of landlord-tenant stuff. I did a lot of evictions. The way it works here in most places, in the States, the sheriffs go to the house, they post a 24-hour notice on the door. Here, it's the marshals at the court. They return 24 hours later, they get into the house, the marshal somehow. They break it, the landlord gives them the key. They take the tenants out and they put them on the curb with what they have on their back. And then they close the doors and secure it. So it is a pretty rough process. So we have to wait until that is done if it's an eviction issue. That's the only time, in 5 years since I've been here, that's the only time it's ever gotten ugly like that. Most times the tenants usually comply.
Does a multifamily, does one unit being open suffice?
No, they've got to be, well, yeah. If one unit is open, no problem. Yeah, so we can do a fourplex on the residential side. And if they're gonna move in to that empty one, that's fine. Yeah, so long as they can move into one of them and treat that building as their primary residence, that's okay. Yeah. Next. Powers of attorney, they're not, we can't use them as liberally as we did in the past. So Freddie Mac made a change in January where POAs can no longer be used out of convenience. There has to be a bona fide hardship. So service members, there's all sorts of exclusions, but if it's because the husband's traveling somewhere, well, he's either got to go to an embassy or get before a U.S. notary and sign his documents, and it's a mail-away closing.
Are you working on being able to do online?
Right now, we're not doing accepting online e-notaries, but the title company, all their documents can be e-notarized, just not the mortgage when it's not notarized. Yeah. I have a form, POA, anybody asks, I'll give it to you. It has there's a specific language in the power of attorney called Regulation Z that's in the Consumer Financial Protection Bureau, the Truth in Lending. Any other power of attorney won't work. Next. Bankruptcy. Don't always dismiss your clients that have had a bankruptcy in the past. Ask them, have they gotten a car or a credit card? If they've gotten a car or a credit card, they've got a loan for it, and they've reestablished their credit. I closed a loan for a woman who refied her house, and they did Chapter 13 5 years ago, and they felt like they could never get a mortgage again. But her scores were 750, and she went from paying $1,800 a month, and she had the house for 20 years, and we put her back into a 30-year for a reason. She's only paying $200 a month. We put her to 30-year because she's looking for property to build a new house on, so that it's going to be over a year before they find and build a new house. And when the tenant moves in, it's a $300 a month mortgage payment overhead instead of a 15-year term. It's just more profitable. Just send them in for a pre-qualification. Maybe they're qualified. Next. Refinance opportunities. So if you do any property management, you get the mortgage statements. Take a look at the interest rate. If there's an opportunity where it's at least 1.5% difference for what's going on now, see if your customer is willing to refinance. One, that's going to strengthen your relationship that you're looking out for them. Two, it's going to make them more profitable, and they're going to make more money because you have an ability to lower the mortgage payment. It's a great way, and for them to stay with you. Cash out refinance. Maybe they want to cash out a property so they can build a new property or buy one that you can manage as well. Okay. Next. The other products, cash out refinance, refinances, those are really popular right now. And if you know anyone that has a Citibank mortgage, they shouldn't have one anymore. Those are like 7 and 8%. And I don't know why people still keep them. So just refinance and get out of it. Turnkey refi, that's when the contractor pays for the construction of the home. And then you refinance the debt owed to the contractor once you can move in, when the DPW blesses the property. It's a refinance, so you're getting a new house, and all the closing costs are wrapped in except for the appraisal and the flood. So your out-of-pocket's going to be less than $1,000. It's a great way to do it. It passes, you know, it'll be built to code because DPW has to go out and inspect it. You can hire your own engineer. I would if I were you to go out. Typically, the things that are not included in a construction or a turnkey refi agreement is the cost or the act of connecting the utilities. Typically, it's GWA and GPA. The contractor will build the pedestal for the power, but if it's on a main road or something like that, there's no way the contractor is going to tap into the main line. If they're tapping into a spur line deep into in a village for water, they may do that with an authorization or oversight of GWA. We do equity lines, so second mortgages. We can only do second mortgages on primary residences. If you want an equity line on an investment property, we can do that on the commercial side. Credit cards, secured and unsecured. Secured credit cards are great. If you've got someone that you're working with and they've had issues with their credit, tell them to get a secured credit card. Do not go get a personal loan. Do not go buy a car. Don't have someone put you on a cosign for it. Secured credit card, $500, we give you a $500 limit. And it reports to the credit bureaus. And no matter what, it's going to get paid in full every month. It's a great way to build credit. It's a great way. And also you can use a secured loan as a tool for saving for your home. So you take out $1,000 secured loan. So if you put 1,000, then it's frozen. We're going to give you 1,000. Every time you get a paycheck, pay back the loan with your paycheck. No faster than 6 months, so it can report to the credit bureau. Now you've got $2,000 in your savings. So the act thinking of it, tricking your mind that it's a loan, may force you to save more. It may be easier for you to go through that saving process. Commercial loans, I've had a couple commercial loans that I've passed over because they didn't meet the residential requirements, but a commercial loan analysis is much more liberal than a residential analysis. We're confined by what Freddie does for the most part because they're kind of the standard in the industry. And it's very similar with Fannie Mae, how you treat income. But on the commercial side, we can use the proposed rent on a home that's not even built yet to factor to qualify. So for example, someone came to me, they wanted to refinance their property to buy a foreclosure. But they didn't have enough income. So what we did was, we went to the commercial side. There was a foreclosure property, it was 1 acre with 3 units. We factored in their base pay and then the future rent on that property that was being foreclosed upon that they were going to buy. And we gave them a loan to go out and buy it. And they won the bid. So it's a much more flexible way. And sometimes it's just more important to get the property and not worry about the interest rate too much, because after 2 years, he's going to come back and he's going to refinance under the residential side for a much lower fixed rate. But the interest rates on the commercial is generally prime +2, so it's less than 7%. It's not awful. It's still less than Citibank. We do personal loans, auto loans, and all your checking and savings accounts that you want, time deposits. Any questions?
Just to clarify before I clarified, in this situation you just mentioned, you would allow after a 2-year period to get from commercial loan to the residential one?
So when you're dealing with rental income, you have to have that rental income seasoned for 2 years. So you've had to have the tenant for 2 years. So you get it under the commercial, under the future income from the rent that you don't have yet. And then once you have the rent for 2 years, then that rental income can be considered eligible on the residential underwriting side. Anything else? Matt, anything?
You guys have any questions?
Come on. You're a loan officer, grill me.
Your origination fees.
Our origination fees are either 0, 1, or 2.25. So that's called buying down the rate. So par is no fee from us, and at 1% origination fee, you'll get a slightly lower rate. At 2.25% origination fee, you're gonna get a much lower rate. We can go at if you, under a 15 year, we can give you 1.75% interest rate fixed if you pay 2.25% of the loan amount as a fee. So I tell people, people under the VA loans, to be perfectly honest, that they're gonna be here for maybe 3-6 years at most if they're PCSing in. They should get into that house with, you know, as little as possible. There's no way they're gonna hit the principal. There's no reason to go after the lower rate because they're probably just gonna sell in 3 or 4 years. But just get the house and have somewhere nicer to stay than base. On people who are refinancing, it's a real savings if you look at the long haul. But it's a net savings of maybe 20, 25 grand when you factor in the cost of that upfront fee and versus the yield of the long-term savings. So I tell people to get an amortization schedule from Excel and tinker with the interest payments.
Yeah, so Hillary and I will buy down the rate if it pays back within 3 years or less. Because we do that on our investment properties to basically have an upfront cost to increase our cash flow over time. So if it comes back and we just do the math and all it is, hey, if I don't pay anything, it's gonna be $1,100 a month, and if I put 2.25% points, it's gonna be $1,000 a month. Well, in 3 years, that makes me $3,600, right? Or saves me. So if the points are 3,600 or less, we would do it because we're looking at it for long term. Yeah. But what he's saying on the homeowner side is, you know, we get a lot of members that qualify for a lot and they don't have any money in their account. So on Guam, we've seen appreciation plus cash flow through their OHA. So we want to get them into the deal as easy as possible on them. And then, you know, even Thomas talked about it at our training, even if they take a higher interest rate to get into the house for as little as possible, 6 months hit, they can technically refinance it back down to, you know, using the VA IRL that we talked about.
Yes, and that the VA IRL is a great program. There's like, we have to charge an appraisal fee because we have to get an idea of value, especially if it's coming from another lender. The VA permits us to close the loan without an appraisal, but we can't sell it to Freddie Mac without an appraisal. So it's a great loan program. We've done a lot of, saved a lot of people a lot of money. And there is no income requirement on an IRL. They're a veteran, they could have lost their jobs, they're only on their VA retirement, they lost their, straight pay, wife is out of work. So long as the interest rate, if it's a lower monthly payment, we can do it. Credit score doesn't even matter. You don't even have to pull a credit report.
It's essentially just almost a no-doc rate and term refinance. So all they're doing is resetting their 30 years and knocking down the rate to current market value.
Yeah.
And so he's saying for their bank, only out-of-pocket cost is that $600-700 appraisal. They cover everything else.
Yeah.
And the funding fee that we talked about, significantly less for the. Do you guys pay that for them? So some banks do.
The funding fee? No, it gets discounted though. It's at 0.5%.
Yeah, so super low.
We include it all. So generally they don't have to show up with anything except for the appraisal. That's the only out of pocket for them.
$600, $700.
Yeah.
You guys do reverse mortgages?
No, and I hope we never do. They're evil. So, when you're talking to people, what I've found is I will help you guys be the go-to person for anything real estate to your customers. So if you want to ask me something before you approach your customer, ask me, please, because it only strengthens their perception of you that you're going to them with solid information. So when they come here to me, everybody's on the same page, okay? Because I need you guys, and you guys need lenders. So the better way that we can strengthen relationships, it's better for everybody. And I think it gives the borrower, it's smoother for them. I'm a loan officer. It was stressful when I bought my house here. So imagine for somebody who's outside of this process, it's nerve-wracking. So anything that we can do to help them stay at ease is a good thing. But I've left cards. Email me if and one thing about me, I do not answer my phone if I'm with someone. So if I'm not answering, it's because I'm with someone. Shoot me an email and I'll give you a call back as soon as I can. It's usually the best way.
Can you use a rental income for occupied units for purchases?
You can, no. Because it's only on a commercial. Because it's not their rental income. It has to be income that that borrower has been receiving for the past 2 years.
On the residential side.
On the commercial side, we can do it. Do you guys get PTRs before you list?
We requested 2 today, actually.
Thank you. Sometimes it's,
I requested them, we requested for the meetings. If I can get them in time, we'll take them to a listing appointment.
Really?
To show the seller that we already, no other agency's gonna show up. So as soon as we set a listing appointment, we try to do a week out if possible, and we immediately email security and pull BOR.
yeah. Good.
It's an easy thing to do.
It is, and it's $100.
It's free for us.
Really, it's nuts.
They should.
That's not bad though, I guess because you.
So if you need one, just email me and I'll email it for you.
That's okay. For my properties, they give me a break every now and again.
Yeah.
Yeah. I don't know. All the title companies, they get the job done. Some do a better job than others. Some are a bit more timely than others. But maybe if you get a good escrow officer and to work with, it does help. So for you new folks, get to know the escrow officer.